Welcome everyone to the March House View from Sygnum Bank. Thank you everyone once again for joining us. The theme for today is Inflows into Spot ETFs Accelerate. So Katalin Tischhauser, our Head of Investment Research, is here again. Hi Kat, how are you?
I'm very well, thank you. How are you?
Fantastic as always. So again, as always, all the content and opinions presented in this live stream are not investment advice. So let's get cracking. So there's certainly been an exceptional month in the crypto market, Bitcoin leading the way. Yesterday, a momentous day, Bitcoin matched its all-time high of around 69,000 on Coinbase, surpassing its previous 2021 peak. Ether and other tokens are also rallying. And overall, the crypto market reached over 2.5 trillion in February, making the first time it's hit that spot since April 2022. So let's start, I guess, at the beginning again. There's a lot of momentum here. Katalin, talk about what you see as being the underlying drivers for us first.
Sure, and as you said, the market's performance has been really extraordinary in the last few weeks. It really the market really accelerated to the upside. Just to mention a few numbers, February actually was one of the largest percent moves for any month ever, and the largest move in dollar terms ever in the crypto market. And as you said, we reached and matched the previous all-time high. And the reason, the impetus clearly came from the ETF inflows, the inflows into the newly approved spot Bitcoin ETFs exceeding expectations very significantly. Of the forecasts that were in the public domain, the low end was $10 billion for the full year. We actually had $7 to $8 billion in 6 weeks. The average forecast come out around $30 billion for the full year. So clearly we were progressing at a much, much faster rate and actually matched or even exceeded the most far out extreme crazy forecast. So this, of course, influenced market sentiment. Naturally, it led people to reassess the fundamentals, but also in a very practical sense, it created a demand shock because basically just there was a lot of money looking to buy Bitcoin and there isn't a lot of liquid supply around. And actually, the newly issued Bitcoin spot ETFs have been breaking so many records in ETF land relative to other ETFs. For example, the BlackRock Bitcoin ETF got to $10 billion of AUM in 6 weeks. This is the largest of the newly issued ETFs, and there's another 3 that's above 1 billion. But getting to the 10 billion record in 6 weeks, this is unprecedented in ETF land. The previous record was the gold ETF. It took over 2 years to get to 10 billion, and the largest ETFs are the S&P 500 ones. The biggest ones took between 3 and 6 years to get to 10 billion of assets. And also it is quite interesting to mention that for BlackRock and for Fidelity, even though the Bitcoin ETF is just a tiny percent of their assets, of all assets and all ETFs, really a fractional percent, they actually accounted for between half and 2/3 of their net year-to-date ETF inflows. So that's also pretty amazing. And also I would add that a lot of forced selling was also absorbed. So not just the net inflows that I have been mentioning, but also there was a lot of forced selling of the Grayscale ETF, which previously was a closed-end fund. People could only sell it at a significant discount. And now the various bankruptcy states, the FTX, more recently Genesis, when they were allowed to sell and able to sell through the ETF, then they have been basically forced sellers of billions and billions of this, and that was also matched and absorbed by the demand. And these inflows are actually continuing. Yesterday was the biggest day yet for the BlackRock ETF in terms of inflows, reaching almost 800 million just in one day.
So, but what about moving forward? How do you see these drivers in the next sort of weeks and months?
Yeah, so it's the expectation always was that demand for these ETF products would ramp up gradually. A lot of platforms that would offer it, brokerage platforms, investment advisors, for example, have a rule that a new product has to be trading for 90 days before it can be approved and offered. Others just simply have a kind of a process that takes a while. So actually, this is still a lot of this demand is still yet to come, is still in the future.
Really?
There was a Fortune article that mentioned, I couldn't check the accuracy of the number, but it mentioned that currently only 20% of US investment advisors have the Bitcoin ETFs approved for their clients. And we are seeing announcements from major platforms. At the end of February, we had Bank of America Merrill, we had Wells Fargo, among others, also saying they approved the ETF products. Morgan Stanley announced that they're evaluating it for their brokerage platform. So this keeps continuing, and it is expected to continue throughout the year. And to me, just to go back to January, when the ETFs were approved and launched, and there was this sell the news market move, that sort of, other than a correction, which of course always happens as the market moves up, but that kind of sell the news logic never really made sense to me. Kind of saying that the ETFs are now all in the price now, it's all discounted, because even if the volumes hadn't exceeded the expectations, and they exceeded it very significantly, but even if they hadn't, there was going to be a constant flow of buying, and to be honest, not a lot of supply offered to match all this demand. But beyond the ETFs, it's not the only story. I think the other very significant story is that institutions started allocating to the crypto asset class. Now, this is, in terms of major institutions, a new development that we saw the first announcements last month. Fidelity, one of Fidelity's branches, Fidelity Canada, added between 1% and 3% of crypto to various portfolios. Morgan Stanley changed the prospectus of one product to allow up to 25% crypto. There have been smaller investment managers doing similar things. Franklin Templeton announced that they're doing due diligence on adding the crypto asset class to their portfolios. So this has not yet really turned into inflows, but this is starting, and this could be bigger even than what we're seeing going on with the ETFs. And this is not just a trend in the US. We also saw recently at the end of February, that Japan changed regulations to allow investment managers to add the crypto asset class. And then we're also seeing, in terms of the demand, it's not just the new products and people embracing the asset class, but basically the global macro picture continues to provide an impetus for allocating to all sorts of safe haven assets. That includes precious metals, but also Bitcoin. And with the EU economy flatlining, Germany deindustrializing, the world de-dollarizing, and really seeing geopolitical tensions just continue getting worse. And I would say even in the US, where people describe the current economic backdrop as kind of a Goldilocks scenario, I think it's clear that it's built on fairly shaky foundations of escalating debt. It's a government that just keeps spiraling out of control, and also individuals are using up their savings and running up credit card debt. Actually, personal savings in the US declined by $1.9 trillion over the last 2 years. So basically, people are running down their savings and running up debt, and that's keeping the economy going. So against this backdrop, there's a lot of demand for gold, and gold's been doing very well as well, but also for Bitcoin now. People increasingly diversify their safe haven investments into not just gold and precious metals, but also Bitcoin. Actually, last month, there was a very clear rotation from gold ETFs into Bitcoin ETFs. And in summary, I would say the outlook for future inflows into the crypto asset class looks pretty robust, and I see the potential for more demand shocks to come.
Yeah. Certainly, in terms of the cycle, it seems like we're moving into uncharted territory already. What do you think on that market level? Do you see some different scenarios playing out?
Yes, I mean, as we obviously already mentioned, a lot of positive fundamental drivers in place. But if we just look at a typical bull cycle and the typical bull cycles in crypto, they have been very similar and very predictable. And in terms of their duration, there is still more to come just based on the pattern of past cycles, but also in terms of late cycle behavior, we don't see that yet really. Maybe are seeing just the beginnings of moving out of the early stage of a bull cycle. And for example, rotation into smaller tokens is one of the hallmarks of later stages of a bull cycle, and also a very high level of retail interest would be. And that's also something we're not seeing yet. For example, one indication, of course, retail interest is increasing, but it's nowhere near previous bull cycle levels. One indication of this, for example, that people often look at is Google Trends. And here the kind of Bitcoin crypto search terms are way below where they were in previous bull cycles. So that's often a good proxy metric for retail interest and retail involvement. What I would say is that the market is becoming more volatile at the same time. Futures open interest is at an all-time high, and that introduces naturally more volatility, and the market is of course prone to corrections. That's always the case. I have heard also comments that the halving would trigger a serious sell-off, and because the low-cost miners after the halving would be forced to sell down their Bitcoin holdings. And this is something I just cannot see at all. At the moment, even the highest cost miners will be very comfortably profitable even after the halving. So I don't sort of see the rationale of where such a market moves. There could always be corrections. There are always corrections in a bull market, and there are always deck advances in a bear market. But I don't see that any miner would have any business reason to sell down Bitcoin holdings to fund their operations, because they're all comfortably profitable, even the highest cost ones, even after the halving. And also, it could be that the hash rate, the computing power committed to Bitcoin mining declines. But here, this is a long understood relationship, that it's not the hash rate that drives the Bitcoin price, but the Bitcoin price that drives the hash rate. Okay.
But turning away from sort of pure market and dynamics, what else is catching your eye at the moment?
Well, there's always the regulation is a factor that we always have to keep an eye on, and I think there's always a lot going on, some of it positive, some of it less so. But the most important to my mind is these various lawsuits between the SEC and various US exchanges, Coinbase, Kraken, Binance US, that all hinge on the SEC claiming that most crypto assets are securities. And the outcome of these lawsuits in terms of will Coinbase be fined or something, that's not really very relevant or interesting for the market, but it would be very significant if it is accepted that most crypto assets are considered securities. Now, actually, the news flow, there's always news flow trickling out on all these court cases, and the news flow has been leaning positive, basically in terms of in crypto's favor, and the market's expectation is that it will be resolved eventually in crypto's favor. We're not expecting it otherwise, but it is definitely a risk and something to keep an eye on. And the Ethereum spot ETF approvals could also play a part here, because it could be that the SEC approves the ETFs, the Ethereum ETFs as security ETFs, not commodity, which wouldn't be a problem for the ETF approval. In fact, security ETFs have a simpler approval process than commodity ETFs, but it would be, of course, a line in the sand in terms of the SEC formally considering Ether a security. And until this is finally settled, this remains a risk that we should keep an eye on.
Yeah, I mean, but away from the courts and regulation and Bitcoin even, we were talking a little bit before about some interesting areas of innovation that were bubbling up. I'd like to talk a little bit about some bright spots you're seeing.
Yeah, lots of bright spots, and one, of course, just to mention, Ethereum itself has quite a number of positive catalysts at the moment. To which one more was added recently when traditional corporate treasury, where we have seen a trend of corporate treasuries buying Bitcoin for a while as a safe haven asset. We saw the first traditional corporate treasury buy Bitcoin and Ether. So de facto basically considering Ether also a safe haven asset. And if there is some additional demand for Ether from that quarter as well, then that's an additional positive in addition to the other ones that we have talked about before. And there's another trend starting to develop that I'm actually really happy about, which is that more and more projects are revamping their token economic models and channel some of the platform's revenue to token holders in some form. It could be staking, it could be token buybacks, it could be token burning. So it's not kind of traditional dividend payments or what would happen in traditional finance, but in some form, some of the revenues of the platform are used to enhance the value of the token, and the market's reaction to these situations have been very, very positive in every case. There have been quite a few. The most recent one was Uniswap. And as soon as it was announced that Uniswap proposes to channel some of the fees to token holders, the token rallied within 24 hours. It rallied 70–80% immediately. So I think these token revamps are a very helpful development as the market cycle progresses and broadens, and people start looking at tokens beyond Bitcoin and Ethereum. It's also a good sign that the market understands value better and better, and that projects are responding to this.
Yeah. Very good. Well, I think we're almost out of time. Okay, thank you very much for today's interesting session as always, and for breaking it all down. So everyone, for a deep dive into this and other important topics, you can download the March House View from Sygnum Bank. It's on our website in the Learn section under Research and Education. So as always, please visit the Sygnum website and follow us on our now 30K plus community on LinkedIn to stay up to date on all of our launches, news, and research. So thanks, Kat, for today, and everyone have a great day.